Okay, good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for June 2nd, 2012. We'll cover the usual topics. Excuse me. We've got a market that is now in sideways volatile. Friday's selling pressure basically was enough to finally tip it into sideways. So that's not good for the long side. Very good for short-term tactical traders, however, that can take a position in either direction on a moment's notice. On an annual basis, we're still at 48 out of 100 using weekly RSI 14. The 10-day NDX is at minus 28 in the red. And so what that means is if you took a look at the previous 10 days trading range, not counting Friday's price action, but the 10 days prior, Friday's action closed 30% below the previous low of that 10-day trading range. So that's a breakdown of 30% of the trading range proportions. And that's sort of the beauty of the 10-day NDX because it gives you that kind of magnitude of those breakdowns and breakouts. Percent stretch relative to the 200-day moving average is yellow. It's at 0.24%, so it's just a shade above the 200-day moving average itself. And because it's within plus or minus 2%, that puts it in sideways condition. The yellow code means, of course, that it's in the bottom half of strength of the last 6 months. The slope of the 50-day moving average got worse at minus 0.65, which is coded red and bearish. Meaning that is among the worst negative slopes that we've seen in the last 6 months. ADX 14 is at 29.4, which is a strong bear. And ATR percentage is just a shade under 1.5%, well into the volatile range. That has basically doubled in the last 6 weeks. It was down around 0.79. Now it's above. Now it's almost at 1.5. So we've got a sideways volatile market that is in oversold conditions. Now that's really good for a short-term trader because we have intermediate term. The market is at a moment of indecision, meaning it could go violently in either direction. And on a 10-day basis, it is also closed at an extreme. And so when it's extreme on both short-term and intermediate term, we have all the potential for a really sharp move and in either direction because the classification is sideways. It can go up violently just as it can go down violently. The blended monthly rebalancing occurred this week and in both of the portfolios, the 13 ETF and the 26 ETF. The holding is TLT and then 2 scoops of the short-term ETF, the cash position, SHY. Next reevaluation is due on or about 1 July. ETF2, the theoretical model, is at, that should read 50%, excuse me, I forgot to change that. It's at 50% because there was a sell on Friday when the stop was hit. And the theoretical exposure is 0%. Next up is just a quick look at the 2 portfolios. You can see right now that in the 13 ETF, the only thing that's on a buy signal is TLT. And so the next 2 strongest ones, IYR and QQQ, are both on cash. So that means we substitute the cash ETF for them. So that's where you get the 1 scoop of TLT and then 2 scoops of SHY. In the 26 ETF portfolio, same basic thing. The only 2 that are on a buy signal throughout the entire portfolio are TLT and SHY. So you get 1 TLT and then 2 of SHY. You can see the relative strength of U.S. real estate with IYR near the top here. But even that one, which has been strong for so long, is on a cash position. Right, next up is the market health check. And again, you can see we're in sideways volatile. Taking a quick look at ADX 14, you can see how back in excuse me, late May, the ADX crossed over this declining bull, and based on the strength in the bearish price action, started getting a strong a strong bear signal, excuse me, about the middle of May, and now it has moved up to a point where at 31, it's extremely strong bull, extremely strong bear. I keep wanting to say bull. In the price action itself, you can see the previous swing high still holding at 142 in purple, and then at 136 and 134 are two other resistance levels that used to be support levels and would be price targets on the way up where we would expect to see hesitation. This price here at about 129.5, which had been the previous swing low here. When it broke hard on Friday, and now we're well below that at 128. You can see up here that the 200-day moving average is 127.85, just barely off the chart, and so we should see the shaded area start to show up as we get more weakness in the market. See, the 10-period moving average has closed outside of the river. The river is getting wider, and that's the 30-period Bollinger Band. What we have now, the river is defined as this shaded blue area in the middle, and that is a 30-period Bollinger Band on the dailies, plus or minus 1 standard deviation. That little dotted line in the middle is the Bollinger Band mean. That's the equivalent of a 30-period moving average. So you have price well below the 10-period, which is declining, and the 10 is out of the river and declining. The river has rolled over and is flowing south and getting wider as a function of increased volatility. Even the 50-period moving average, it went to zero right around the 5th of May. And as I've told you a number of times, when the slope of the 50 is positive, that's good for the market. When it goes to zero or rolls over, that's bad for the market. You can see some evidence of that right here as we look at it. Let's take another look at that. So this thin red line here in the middle is the 50, and you can see right about here when it broke down sharply on looks like about May 6th. That was sort of the indicator, the max, we call that in artillery, max ordinate, the high peak of the that slope. And now the slope is getting progressively weaker and rolling over, and that's bad for the market. Williams percent R10 is oversold, but it can stay oversold for a long time in a bear, which we're getting close to. PPO, percent price oscillator, it had flattened out, but now the jaws have opened to the downside again, and that's negative. From the swing high at 142, the 5% retracement box here was at 135. You see when that failed, we get a lot more failure. The 10% and that would this 5% pullback would be considered market noise, and then between 5 and 10%, we would consider that to be a correction in a bull, excuse me, and we're violating that now. Anything after 10%, you will hear the market gurus talking about bearish conditions. So when you combine a 10% pullback that has put us right on the 200-day moving average, there's a lot of tense institutional money that's getting ready to hedge. And so what we've seen so far is just the first wave of selling, in my opinion. And another wave, we could see another 5 to 8% here pretty easily with just any kind of trigger of bad news. The black line in the middle you see is the slope of the 30-period regression line. That is the 30-period regression line. And then the black channel outside of that is the regression channel formed by the maximum excursion from the regression line during the look-back period. Significantly, that happened on the downside. The blue channel is simply an Andrews pitchfork that takes that last regression channel and extends it forward. And this basically tells us where would price continue to be if the underlying functions of the market that have produced the previous prices continue to do the same thing. So as long as it stays in that channel and nothing significant technically or fundamentally changes, we would expect to see price continuing to track that center regression line downward. Okay, moving on. Not much good news on that one, by the way, unless you're short. All right, next up, the ETF2 database. You can see all the indexes are on a cash, and that puts the theoretical model at 0% invested, 100% cash. SPY is still better than EFA, with 68 being better than 53. Inside the U.S., it's still technology, then large caps, then mid caps, then small caps. The NASDAQ and SPY are the two strongest. Latin America and emerging markets are the two weakest. So once again, the ETF2 database has given us some good early warnings as it got started with rolling over before this last wave of selling, which is why I pay attention to it. You can see the U.S. market now with the world market model. The U.S. market is still all above average. Everywhere, every other equity that you want to look at is horrible. Europe is well below average. Asia and Japan, Asia-less Japan are weak. Only Malaysia, EWM, is above average. Latin American emerging markets are just horrible, as is Brazil. Everything in Europe is bad. The only thing that looks promising in equities are these, the defensive plays. This is the risk-off trade for people that have to own equities. That's consumer staples is XLP, XLU for utilities, and XLV for healthcare. And they're also among the strength leaders globally. But I think you'll see, even in the defensive plays, the global sectors are lagging behind the U.S. That's that flight to quality, a real concern. Moving on. The top 30 ETFs in the ETF2 database are up next. Home construction, and then you're going to see a bunch of bonds, everything bonds. You got some income coming from real estate, and biotech is still speculatively good, although again, even those are flashing a warning sign on their cash position. So everything else you see is bonds. Even XLP, which is that strong sector spider in the S&P, is on a cash sell. You can see retailers, utilities, and consumer discretionary are all on a cash position too, but they're among the best. I guess the only exception would be XLU is on a buy. Excuse me. So otherwise, it's the defensive plays and then everything bonds and real estate, and definitely the world favoring the U.S. Over the globals. So this is not good news by any means. Quick look at the Dow 30 is up next. And again, this is sorted by strength. It's Pfizer, Home Depot, Travelers, Coke, Disney, Walmart, AT&T. Those are the components of XLP. That's all your consumer staples right there. At the bottom, things that used to be really strong, JP Morgan. McDonald's is still a surprise to me. But Caterpillar, Alcoa, Hewlett-Packard, Cisco, United Tech, Chevron, these are all the strong producers in the basic industries and basic materials, and they're suffering as part of a slowdown in the economic sector, even in the U.S. So it's the consumer staples. It's not the engine of the economy that's working right now. Moving on. The last chart on the weekly, the volatility. You can see that's starting to hook up here in the last, this is the last 180 days on the right. This is the 5-year look. And this is the 30-day standard deviation divided by the price, and then it's comparing percent so that we can compare apples to oranges. And you can see, I think, that volatility had bottomed out here, and we're starting. This is enough of a move in the last 2 months that that the market has actually moved into volatile conditions. Now, if it breaks above this 0.8, then we're really back into significantly volatile market conditions. That will be a big concern. Lose another 10%, and that will shoot up just like it did in August. Okay, we're going to shift now to the daily report. Oops, I shifted it to 0.91% when I wanted 91%, so it's like we're looking at it from outer space. Sorry about that. Okay, I'm not going to read the top row again, so we'll just go right to the second row. Yeah, I'm just going to go right to the mechanical rules. There's really nothing in the gap stat that's interesting. You can see the time series on the 10-day NDX is sold way off. You can see how wide the daily pivots are between 123 and 133. That tells you just how volatile Friday was and why Monday should also be a roller coaster. Couple signals in channeling and the overreaction system, but those are limited to the two strongest of the U.S. sectors, SPY and the technology. You'll notice everything else is already below its 200-period moving average. So the U.S. S&P and the technology sector remain the last bastion of strength among the equities in the world. So you may not want to take those signals, or play them very close to the vest on Monday, and look for them to reward on the upside if there's buying pressure. People will be buying the S&P exclusively, I think, rather than venturing into the risk-on trade. You can notice here that the ATR percentage, had been quiet for such a long time, and now has made this decisive move up. 10-day max pains. JP Morgan, Caterpillar, Bank of America, Hewlett Packard, American Express, the winners. Natural gas, oil, Russia, and then oil and exploration. Those have been the losers, the losers on the ETF side. The winners have been gold, treasuries, gold miners, and then AT&T, Walmart, Verizon, Johnson & Johnson, Merck. It's that risk-off trade plus gold. Lots of signals and overreaction and channeling, but these are really relegated to the strongest of the ETFs and the Dow 30, because the other ones are below the 200-period moving average. You got 5DD in natural gas, ExxonMobil, and McDonald's. That makes McDonald's worth looking at. Verizon on a triple screen, and then a whole ton of things that test out well on the auto framer, and that's just because of the massive sell-off on Friday. So that's going to favor that auto framer because the 10-day high was so far away. Okay, moving on. Next up is the Dow Tactical. Just a handful of dojis, 3 dojis in there. ExxonMobil and Chevron. ExxonMobil is interesting because it's a 5-day down. It's a max pain. It's number 2 on the max pain range compression, and it tests out at 3.7 to 1 on the auto framer. You should definitely be looking at ExxonMobil on Monday. We should look at McDonald's. It tests out at 3.3 to 1 on the auto framer and is also a 5-day down. Verizon is a triple screen, but doesn't test well on the auto framer. You may have missed it the last time I talked about this. This RSI2 column, this is a new signal here. That just takes a look at the 2-day RSI, and anything below 10 means that it closed horribly, in the bottom 10% of its daily candle, and the last 2 days have been particularly bad. And that's I know Mark McDowell's been looking at that as a tactical entry filter. And really take your pick now, because just about everything was horrible. In fact, only AT&T and Walmart were respectable. I mean, they had 41 and 47 respectively. So you can see now that Walmart, with all the greens here in the price change percentage, and AT&T, those are some relative strength winners in the Dow. That's why they've been holding up pretty well. Next up is the ETF tactical. The same lens, if you will. We have only one doji, that was AG, DBA. Take a look at all the ones that test out really well on the auto framer, and that means that all the big indexes get smacked down together. Natural gas, oil, ag, coal, and mixed commodities are the top 5 big-time opportunities developing over in there. DBC is an interesting way to play that because you get a blend of precious metals, base metals, energy, and grains, all commodities. It tests out at 3.1 on the frog quality number. It had an RSI of 1, so it had to have been limit down. But it tests out at 5.2 to 1 and is number 5 on the max pain range compression. So DBC, blended commodities, ought to be on your short list. But you can see some of the commodities did well. Silver, treasuries, gold, and the VIX were the big winners on Friday. And only natural gas on the 5DD pattern. I want you to notice over here on the far right, all of the different NDX measures for 10 days, 1 month, 3 months, 6 months. All that red says that each and every one of those broke out below its previous trading range on all of those time periods. So that's just how bad the price action last week and on last Friday really was. Pretty horrible. Moving on. Looking at the market mosaic indicators, the additional mosaic indicators. I hate to beat this regression line to death, but, when the regression line crosses over at an extreme distance from the average, at least one standard deviation, that's a signal giving us early warning for potential sea change. And you can see that it is now completed more than a 3 standard deviation adverse move in terms of the steepness of the downslope in the regression line. To the left, you can see that center line is the regression line and just what a violation Friday was. The R squared at 0.74 really confirms the bearish price action as if you needed some additional confirmation. You can see on the percent stretch relative to the 200, it's pulled back almost 2 full standard deviations to rest right at the 0 line, which is the 200-day moving average represented on this index by the dotted red line. Zooming in on the slope of the regression line again, you can see it pulling away from its own 10-period moving average. That essentially gives you the last 30 days. That was, you can see on the northeastern chart up here. So nothing good on the additional mosaic indicators, but that's how you use them for early warning. Here's a couple. Here are 2 new ones that I've added that I really, really like. The first one is the top one. What I'm looking at is the z-score of 3 different time frames, 3 different regression lines. And the 3 regression lines, as you know from RLCO, is the 10-day regression, the 30-day regression, which is the same one we just saw in the previous chart, but I've just mapped it to this one with a slightly different purpose now. And then the red line is the 90-day regression line. The one that I am most interested in is this 30-period regression line. So I put in one that was faster, the 10-day, and then one that was slower, the 90-day. So there's the one third of the RL30 is the RL10, and then 3 times the RL30 gives me the RL90. So that was the reason for picking those 2. I'd already been looking at the 10 and the 30 because I inherited those parameters from what I do intraday, and I was looking to see if they work on the daily, and I think they do. But what's even more compelling now is when you add the 90 period in and you start picking up that slower intermediate term time frame, if you will. So here's how I'm interpreting these things. Now what you see above on the z-score chart on that indicator are bands formed by standard deviations. Because the slope of the 90 changes so infrequently when compared to the 10, that if you just use straight percentages or the straight actual slope, the red line would be basically flat most of the time and the scale would throw you off. So I normalize them by taking the standard deviation of the last 10 years and then computing today's slope with respect to that 10-year look-back period. So what you get is a very stable indicator here. Now in the middle, I've highlighted in yellow this +1 to -1 as a way to define normal for sake of this indicator. And I put this thick blue line here as the 0 line. When the slope is at the 0 line, it's basically a flat. The slope of the regression line is flat because the 10-year average of the slope is about 0. Now, what I want you to notice is that when the first one is when the slope of the 30, which is the black line, when the slope of the 30 regression line crosses the 0 line, what you get is a confirmation now of really bad price action here. That's a pretty good signal. And especially that coincided with price violating the bottom of the Bollinger Band. And you can see this chart on the bottom is 180 days of price, and then the green and the red line form the river. That's the Bollinger Band channel, plus or minus 1. What I want you to notice is how in a bull market, the price going up rides the upper edge of the river, hardly ever coming back into the river. And that started with a crossover of the 30-period regression line from below to above. If you were really good and you looked at where the 30-period regression line rolled over at the bottom of that normal channel, you might have been interested in a entry down around here at about 115, and then stayed with it all the way up here until the price, until the 30-period regression line slope came back to the 0 line, and you would have gotten a move from about 115 to 138 and never really threaten your stop. So when the slope of the 30 rolls over at a distance outside of that yellow zone there, that's a warning. And now, especially on the downside, what I want you to notice is that that's a pretty good warning. Now, if you go up to we look at the red. Now, here's an interesting one. The red line was flat here at about -1.5, and then started to hook back up. This is the regression line that it inherited those stats after the August sell-off last year. When it started getting better, you can get any kind of entry in this area here is very interesting. So when the regression lines get to an extreme and then can't get any more extreme and start to improve, you should pay attention to this. So where we're at right now is the 90-period regression line crossed the 0 line here on the upside and then stayed positive slope all the way until the middle of last week, when it got back to 0, which was sort of a final warning that you might want to be taking profits in here. If you had paid attention to that, we'd be missing all that pain on the bottom. Now, the one that I find the shorter term one has some interesting qualities itself too. Notice how regularly volatile that thing is. It always moves at least 1, 2, 3, 3 standard deviations on these little oscillations. There are times when it has moved 6 standard deviations in a very rapid period of time. That 6 standard deviation period there corresponded to a really powerful move off an extreme bottom down here. By the same token, this powerful move to the upside coincided with this big move up, and price hesitated in here, as you can see, and that was enough to make it swing back. So that 10 period looks very much like a little heartbeat. And what I want you to notice now, for those of you who are pessimistic like me, is right now at this moment you have the 30-period regression line z-score below 1, so it confirms negative. And as you can see, the next time we're going to have any support, is like 123 and then 118. Those are the targets on the downside. So that 30 period can really go south. And the 90 period has really voted south too, just got to the 0 line and is going to be heading down. And now finally, the 10 period went from an extremely oversold condition at -2, went above the 0 line briefly, and is now pointing down as well. So the 10 period just started to get bad. So there's another 10 days worth of horribleness still waiting ahead. So that hasn't happened for a while, when all 3 of them were pointing down at the same. Let's see, the last time it did that was well, let's see, right about here when it got negative. And when the 10 just started to get negative, you get that kind of move, which is about a -8%, and we have just started that next leg down. So that could take us to 120 or 118 pretty easily, and that's just if it got as bad as it normally gets when that 10 period oscillates. So what I'm really saying on that is there's a 10% downside in the short term that we're not allowed to be surprised if we see that happen. Now, to make the case on the upside, however, I would also say that we've had, 1 leg down, 2 legs down, 3 legs down, and then a rebound would take us, we would aim for a reversion to the mean, which is the middle of the river, which would be right around 135. So that's a potential of $6 or $7. That's about a 5% retracement, and all that does is get back into the middle of the river, which is flowing downward. That would be a good opportunity to short. So if we do see upside potential, I'm certainly prepared to buy it on the long side, but not to hold it overnight. And then if I see failure anywhere south of 135, I'm going to flip over to the short side once again. So I hope you see the concept behind these two charts here is I think for intermediate term timing, for us swing traders, there's an awful lot to commend itself by taking a look at these Z-scores. So the Z-score and everything I talked about is in text over here, and you can see the formula. And what I'm looking for is the agreement between those indicators. Where are they in their movements? What are they suggesting? I look for the 10 period to be the oscillator to tell me when it's going to roll over short term, and then the 30 period to give me the primary swing trading direction, and then the red line to give me something like longer term intermediate market direction. And with everything, with the intermediate and short term pointing down, and then the 10 period just starting to get bad with Friday's price action, I definitely have a short side bias for the next week. You add to that the market is in sideways volatile using the long-term market classification, and this is ideal time frame for an agile intraday trader who would be willing to hold some positions overnight if you get markets money. And that's my strategy for the week ahead. Okay. A couple other ones that I'm just noodling around with is these are indicators now about the Bollinger Band width. I'm not sure which one I like the most yet. The Bollinger Band channel width percentage is telling us right now that from the one side of the river to the other side, it's a 5% move across the river. Historically, compared to the last 10 years, if you take that as a Z-score, it's right about average of the last 10 years. So the width of that channel, there's nothing that says that this volatility is anything like extraordinary. It's exactly in the middle. So that means that there's still a lot more fear to come into this market yet. We haven't even seen the fear start yet. And then the third chart here is the Z of price, and the blue line is the price line, and that tells us right now that we're at -2 on the Z-score, and the black line is a 10-period moving average of that. So it's not even as bad as it has been in the past, even in the past 180 days. So there's a lot of downside still available. So that's all I want to say on that one. Looking at the fraud quality number report, some very lucrative ones at the top. Again, Bank of America, JP Morgan, Alcoa, the commodities, the VIX is still good. Remember, this multiplies the range percentage that typically travels times the standard, and then it looks at the fraud quality number too, I believe. Yeah. So what that does is really gives us the targets that are both very volatile intraday and then yet reliably so. So it's super frogs, if you will. All right, next one up. We're going to take a look at the holding stays. I'm going to fast forward to that one. On the 5-day holding, our Z-scores are all above 1 in the indexes, so they are just starting to go extremely negative. As an example, over the last 5 days, the S&P has lost 3%. That's a minus 1.31 Z-score. But remember, the worst it's ever done in 5 days is minus 19%, which was a negative 7.6 Z-score. So by no means have the last 5 days been extraordinary at all. Just starting to get over, above average in terms of pain. So we have not seen anything like the worst potential yet. And it looks to me like the market is especially vulnerable as all the support levels are failing, and you're just starting to see headlines this weekend about the fact that all the gains from 2012 have been given back And Zuckerberg has watched half his fortune, or 40% of his fortune, disappear. Okay. I did want to show just a couple clever charts from last week in the chat room. We were discussing market classifications. So I want to show that real quick. This is where I'm heading with my thinking on adaptive market classification. You know, I use that market classification with ATR percentage, which is the volatility stat, and then also price with respect to the 200. However, I think that's still a good one for longer term investing. But really, what I'm shifting towards for my swing trading is what you saw in some of those indicators tonight that I spent some time on, and that is the slope of the regression line. And this is really true for any time frame. The slope of the regression line, which we also call the slope stat, you know, it has three qualities. When that slope is just about flat, it's sideways. You know, and then when it gets above some fraction where it starts to tilt up on a 30-day period, let's say, if we're looking at dailies, that's going to be bullish and otherwise bearish. And that I really like that 30 period. So to me, the trending direction is indicated sufficiently by those three: bull, sideways, and bear. And I really like the slope of the regression line to give the insights into there. I think that has more use. I think the regression line slope gives more timely information and more nuanced information for swing traders than, let's say, the price relative to the 200. That's still fine for the longer term holdings, but I think as we start looking at swing trade and intraday even, the slope of the regression line is more compelling. And then this Bollinger Band channel width, you know, this really measures exactly the same thing that the volatility stat does. And so what I like about the TradeStation bundles 1 and 2 is that they already have the slope stat and the volatility stat built in, so you can actually apply this already. And what's nice is that you can use any time frame that you're interested in trading and come up with a combination of a market classification using the direction of the regression line, which is better than a moving average, by the way, at describing the most recent price action. The regression line is the best fit line, and so the slope of that regression line is the best descriptor, descriptor of the average trend or strength of that trend. So you put those two things together, the quality of the slope and then the width of the channel, whether you measure it by the Bollinger Band width or the volatility stat, that's going to give you a very useful market classification scheme. And so I commend that to you for your study. Let's see if there was anything else I wanted to look at. I think that's basically it. We're about an hour into this now, and so I'll hang around for a few minutes for questions, but otherwise get ready to hopefully try to root for the Celtics and help them in their quest to punish the Heat. So I sent around a little survey for folks, give us some insights on the mastermind. I got one of my grad students, one of my doctoral students, is going to do some math for me on it to help us, try to get a sense of the community and see where you are valuing the work we're doing and directions you might want to go, and just kind of a quick scorecard and to give a little direction to us. And then we hope to write about what we're doing, trying to assemble a community of practice around the world through the use of digital technology, and turn what can be a individual lonely pursuit in the markets into something like a supportive community of like-minded, generous traders. So this is an attempt to try to get our arms around that. So if you get a chance to fill that out, we'd sure appreciate it. And of course, everything will remain anonymous, and we'll take it from there. So thanks for your attention tonight. Hope the weather's good where you are and you're enjoying this summer. And we'll see you in the chat room. Oh, while I still got your attention, I should also say that the simulator that Frank Eves at IITM has put together for the frog workshop we're going to do looks fantastic. We're going to, just as a preview of coming attractions, we're going to accelerate the daily price action. We'll use 3-minute bars. That simulator will allow you to practice doing the frog trading, but just in a couple minutes for each day. So we're looking at modeling about 100 days worth of trades over the course of about a 3-day intensive workshop, and we're going to pick days of all different kinds. You know, big days, little days, up days, down days, sideways days, noisy days, quiet days, choppy days, trending days, so that we, you know, big gap, little gap, big reversals, whatever it may be. So we get a practice at applying those frog rules. I think we're going to use the Russell 2000 because it's such an excellent candidate for frog trading, and it's well suited for smooth moves and can be traded in the futures. So I think we're looking at I have to check the calendar. I think it's the first weekend or the second weekend of August. But Frank sent me the working copy of the simulator, and it just looks fantastic. It'll really help automate frog trading and allow us to really concentrate on the rules. Our intent is to rehearse the rules, go over them, and then we will work through what the mechanical rules should give you for each one of those days of trading, and then we're going to compare that to the decisions the traders make in order to get an estimate on trader quality number. And then we'll go through analysis of data results and generate histograms and system quality numbers, and try to learn something about ourselves and the frog system by doing that. So I'm pretty excited about that. If that works out pretty well, and it should, all signs point to yes, I'm going to ask them to do the same thing for that regression line crossover strategy so that we can create some intensive, practical, hands-on workshops for intraday trading where we get, you know, in 3 days we can put, you know, 3 months worth of trading experience into a very intense focus session. So if that works out all right, I'll see if we can probably do something like that out here in Kansas City as well. So I'm pretty excited about that one. Anyway, good luck to you guys, and we'll see you in the chat room, and keep your powder dry.